what we've seen in the last 10 years since Lehman, the largest drawdown for gold is only 21%. Think about that. In the last 10 years, the largest drawdown for gold is only 21%. There's a reason for that. And in previous decades, the drawdown was bigger. So this is really strange. The last like 10 to 12 years, in this period, Bitcoin's had 4 drawdowns of 50 to 80% since 2017. Since 2017, Bitcoin has had 4 drawdowns of 50 to 80%. Gold has had only one the last 10, 12 years of 21%. As a store of value, it's building up, gold's building up more and more confidence, especially like last month.
LarryMcDonald, financial analyst and founder of the Bear Traps Report, offers valuable insights into global markets. He is also the author of A Colossal Failure of Common Sense, which details the collapse of Lehman Brothers. McDonald observes that over the past 10 to 12 years, gold's most significant drawdown has been limited to just 21%, marking a substantial shift from previous decades when drawdowns were more severe. In stark contrast, Bitcoin has experienced 4 significant drawdowns ranging from 50% to 80% since 2017. As the 2023 and 2024 financial year concludes, gold has posted an impressive 11% return, nearly doubling the inflation rate. Meanwhile, silver's returns for the same period stand at only 3.2%. Both metals have outperformed their international counterparts, with gold prices rising 10%. In 2020, Bitcoin experienced a significant 16% drop just 2 months before the election, almost precisely on the same timeline. Similarly, in the current cycle, Bitcoin has mirrored this pattern, with a 30% decline occurring within the expected 2 to 3 month period ahead of the 2024 election. McDonald points out that gold is overbought relative to silver, with the gold-silver ratio at 85. Typically, this ratio would fall to the 50s or 40s during a bull market. He also highlights that the platinum-to-gold ratio indicates that platinum is significantly undervalued compared to gold. Analysts report that the ratio recently dipped to a 4-month low of 81 before rising above 83, with ETFs experiencing substantial outflows of 16.8 million ounces this week. This movement suggests that gold remains the preferred safe haven asset compared to silver amid ongoing geopolitical uncertainties. Please tune in for our exploration of Larry McDonald's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
Incentivizing money, central bankers around the world, governments to own gold, that they don't want to own too many dollars. And that's why you're seeing a lot of the big developed countries owning less and less and less of U.S. treasuries. And so gold's a crowded trade right now relative to silver. The gold-silver ratio is at 85. In a normal commodity bull market, it should be in the 50s, even 40s. I mean, in a really big raging commodity bull market. The platinum to gold ratio, platinum's as cheap to gold as we've ever seen it. And so if you own gold right now, for the love of God, you want to be taking, say, whatever it is, if you have some $1 million in gold, 30% should be sold and gone into silver miners, platinum, palladium miners, like uranium miners, just diversify out of gold into different assets outside of the main mothership. And also to add on to this central bank stuff, at the beginning of any bull market, everybody moves into the commodity first, right? Everybody goes into gold first, then it's the miner, then it's the large cap. The cycle is gold, large cap miners, and then junior miners. And so we're not even at the point for junior. So everybody's look at this. Look at Agnico. It's trading at like 20 times earnings. It's more than twice as expensive as the juniors, right? So everybody's hiding out in gold. They're hiding out in Agnico. And we saw the same thing with oil in 2020. Like everybody was hiding out 2021. Everybody's hiding out in oil first. Then they're hiding out in Exxon and Chevron. And, a year and a half later, all these smaller oil companies in the XLP exploded, right? The juniors, right? And it's the same in the uranium space. It's the same in every cycle. The fast money doesn't move into the smaller names right away. It takes a maturing of the bull market to bring the fast money, the speculative money, into the smaller caps. Central bank trade was over the last year. But now it's looking like when you're coming into a slowdown with a deficit that's 7% of GDP, right? Which is World War I, World War II levels. That alone is going to make people want to own gold because if your interest as a percentage of tax receipts are 25% during an economic good period, right? If interest as a percentage of tax receipts, if the GDP slows down, interest as a percentage of tax receipts is gonna explode higher. So that's the type of thing that forces money into hard assets. The other thing is the term premium. So look at last week, right? The 30-year Treasury with the VIX above 50 or 60, I think above 60 at one point last week. The 30-year Treasury couldn't break 4%. Think about that. We went back 20, 30 years. Whenever you had the VIX at a high level, the long end was rallying. And so what we're seeing is there's less trust because of Trump or Hunt Harris and MMT. Both political parties are just crazy fiscal lunatics, right? Because of the uncertainty of that, there's less trust on the long end. And when there's less trust on the long end, that money has to go somewhere. And at one point, Kai, we were talking about this in the chat. At one point, in like the 60s, it takes them from 1960 to from 1968 to 81. In the 80s, at one point, people actually were looking at like they didn't want to own bonds, right? They just wanted to own stocks that pay good dividends. I mean, the people were actually so burnt by bonds by the end of it that they wanted to own other things. They wanted to own gold. They wanted to own gold. I mean, think about this. Barrick Gold was 1.5% of the S&P. Kai.
Now it's not even in the S&P anymore.
But it would have to be like right now it's like a $30-40 billion. It would have to be like $300 to $400 billion valuation if it was 1.5% of the S&P.
LarryMcDonald suggests that gold and other hard assets signal the onset of a new economic regime like the 1968 to 1981 period. He attributes this shift to excessively expanded fiscal and monetary policies, which have led to an economic slowdown and a 7% deficit. Leading banks forecast that global economic growth will further decelerate in 2024 due to high interest rates, rising energy prices, and a slowdown in the world's two largest economies. They also warn that geopolitical risks, including the conflicts in Ukraine and the Middle East, could worsen the global financial outlook. According to a Reuters poll, global growth is expected to slow to 2.6% next year, down from 2.9% this year. McDonald notes that substantial political measures have been employed to prevent a recession, comparing these efforts to betting $1 trillion every 100 days. This comparison underscores the significant and ongoing financial commitments to stabilize the economy. Let's get back to the interview.
There's two types of crashes. The one I talk about in our first book is correlation goes to one. In the Lehman crisis, we had a great New York Times bestseller about Lehman. It's now been published in 12 languages, and it's one of the best books in the world about the previous crisis. And when you have a big crisis that's driven by a financial big bank that goes down, Lehman was almost $1 trillion bank. It was like a $780 billion bank failure. That makes correlation goes to one. So even gold in that period, got hurt. In a slowdown that's economically driven, that's not like driven by a crash in a bank, if correlations doesn't necessarily always go to one. And in that kind of world, gold will go down, but won't go down that much, especially if we know the response to the crash is rate cuts and in a weaker dollar. And so this time around, I'm not saying gold for sure will go down. Gold will go down and always has been susceptible to market volatility. But what we've seen in the last 10 years since Lehman, the largest drawdown for gold is only 21%. Think about that. In the last 10 years, the largest drawdown for gold is only 21%. There's a reason for that. And in previous decades, the drawdown was bigger, right? So this is really strange. The last like 10 to 12 years, in this period, Bitcoin's had 4 drawdowns of 50 to 80% since 2017. Think about that. Since 2017, Bitcoin has had 4 drawdowns of 50 to 80%. Gold has had only one the last 10, 12 years of 21%. So as a store of value, it's building up, gold's building up more and more confidence, especially like last month, right? Like we just had this huge crisis, VIX going through the roof. And once again, when you're long Bitcoin, you're actually short the VIX. Like there's never been a VIX that I can find where the VIX went from 20 to 50, where Bitcoin wasn't in a large drawdown, right? And here we had this huge VIX move and gold was barely in a drawdown. Gold is telling us in some hard assets is that we're really heading for a whole new regime, like a 1968 to 1981 regime, where they've overcooked the goose on the fiscal and monetary, and you're going into an economic slowdown with a 7% deficit, right? And so they've done a lot politically to keep us out of recession. Both Republicans and Democrats do this, right? We saw this in 2008. I mean, today, Democrats have impeached Trump twice. They have had 4 court cases against him, and they went all in with trillions and trillions. They're spending $1 trillion every 100 days, right? That's a fact, right? So they're trying to keep us out of recession by doing the fiscal overdose, and hard assets are telling us that we're heading to that totally new dynamic in terms of portfolio construction in 1968 to 1981 portfolio.
Given the current economic trends and indicators, gold and other hard assets are set to remain central to investment strategies. With geopolitical uncertainties and fluctuating fiscal policies driving market volatility, investors will likely turn to gold as a dependable store of value. This increasing focus on hard assets, supported by substantial financial investments and a low unemployment rate, suggests that these assets will continue to gain importance and stabilize a volatile economic environment. How will the rising emphasis on gold and hard assets impact the broader financial markets? Share your thoughts in the comments below. If you found this video informative, be sure to like, subscribe, and hit the bell icon for the latest updates on financial trends and investment strategies. Thank you for watching, and stay tuned for more content.